Welcome to Talk Tickers. Today, we're digging into O'Reilly Automotive's latest earnings. Now, on the surface, things looked pretty good, but the market reacted, well, not so well. We're going to break down exactly why a solid quarter on paper sent the stock tumbling. And there it is. The market's reaction was swift, and it was decisive, a drop of over 4% right after the announcement. So what exactly spooked investors? Let's get into it.
So this was really a classic mixed report. O'Reilly beat revenue expectations, which is great. It means customers are still walking in the door and buying stuff. But, and it's a big but, they missed on earnings per share. And that's where all the questions about profitability really started.
Okay, let's look a little closer at the headline numbers because they really do tell a split story. On one hand, you've got a strong top line with great sales, but on the other, a bottom line that's really feeling the pressure from growing costs. You can see that contrast right here. The revenue beat and the EPS miss, they were both pretty small, right? But that 5.6% jump in comparable store sales, that's the key number. That is strong, and it shows the problem isn't a lack of customers. Not at all. The real story here is what's happening to the profits after the sale is made. So yeah, the crucial question is understanding what exactly squeezed those profits. Even with really healthy sales, the bottom line suffered, and that is exactly what the market latched onto.
So what drove the miss? We know it wasn't a lack of sales. It all came down to rising operational costs, specifically what's known as SG&A expenses. And this became the main focus of the entire earnings call.
And management didn't shy away from it. CEO Broad Beckham was super direct, saying the company faced, and I quote, substantial cost pressures. He pointed the finger squarely at headwinds from team member healthcare and their self-insurance programs. The specific issues here are things like healthcare costs, workers' comp, and auto liability reserves. Now look, this isn't just an O'Reilly problem. It really reflects these broader inflationary trends that are hitting a ton of companies. But for O'Reilly, these kinds of costs, which are notoriously difficult to control, they just grew way faster than expected, and that created a lot of anxiety about the company's future profit margins.
But even with those cost headwinds, management's message was unwavering. They said, look, our long-term growth strategy is not changing. They plan to lean into the core strengths that have made them such a dominant player in the first place.
And honestly, they've got the track record to back it up. Get this, 33 straight years of positive comparable store sales. 33! This is not a company with a demand problem. This is a well-oiled machine that just consistently gains market share. And their plan for 2026 shows they are not pulling back one bit. They're aiming to open up to 235 new stores, grow sales by 3 to 5%, and generate some really strong cash flow and earnings. The formula is clear. Keep expanding, keep executing, and just keep growing.
So how did investors put all this together? Well, on earnings day, the market weighed that strong growth against the rising costs, and the verdict was pretty clear. Investors didn't just sell the news, they sold it with conviction. Trading volume jumped from about 10 million shares the day before to over 12 million on earnings day. That kind of high-volume sell-off is a really strong signal that the bigger players were heading for the exits, basically prioritizing that cost risk over the growth story. So that brings us to the next call. Given this tug-of-war between stellar top-line execution and these pretty concerning bottom-line pressures, what's our take on O'Reilly heading into the next quarter?
Well, management says they're off to a solid start this year, and we're projecting sales growth probably somewhere between 4.5% and 5% for the first half. But the key metric to watch, it's not going to be sales. It's going to be those SG&A costs. With management expecting that pressure to continue, that's what the market will be absolutely laser-focused on. And for that reason, our rating on the stock is market perform. So here's the thesis. It's simple. The company's operational story and its ability to gain market share are absolutely best in class. That is not up for debate. The risk, however, is the complete lack of visibility into when these SG&A cost pressures will finally stabilize. And until we see some clear evidence that those headwinds are fading, the risk-reward profile just keeps us on the sidelines for now. This is not financial advice.